For more on Alcoa's earnings results and the rest of today's market action, we're joined by Sarah Ketterer, the Chief Executive of Causeway Capital Management, with about $14 billion under management. You're responsible for a lot of money, Sarah. Good to have you with us here on Bloomberg.
Thanks for having me.
All right, so just before we get to the individual stocks and themes and so on, I want to get your impression for the results from the second quarter. How important is the Alcoa number for investor psychology? Because, you know, this is just one company.
Correct. And we think there's nothing to worry about here because much of the problem that's weighing on markets and the risk aversion that's been rippling through equity markets has to do with government debt. It's not about the corporations, who are in generally in great shape. And the demand for products looks strong. The emerging market demand for metals still strong, even with some economic slowdown. So we don't find this at all discouraging, and we think psychology will improve when investors see a distinct improvement in the effort to reduce government debt.
So the idea being that there are a market of stocks, it's not a stock market. Look at the individual companies and don't necessarily get distracted by a lot of the news necessarily coming from Europe, because I know we want to talk about that, or indeed the ongoing negotiations in Washington, the debt ceiling or deficit reduction. It's important, but it's not what drives necessarily individual investment decisions.
Absolutely, and that's especially true in the developed world. And our expertise at Causeway, starting in international and moving into global value equity, is all about the bottom up, identifying companies that are succeeding in their industries and who will outperform the markets. And in a falling market, they may have a tough time, but we're in just a choppy period, in which case identifying the right stocks makes a huge difference.
All right, well, let's use one as an example. I know that Rolls-Royce is a company that you're following right now, and here's an example of a European-based company, but this is really global in nature, taking advantage of expansion in airline capacity.
Yeah, absolutely. So one of the reasons why we're so excited about Rolls-Royce, they don't make luxury automobiles, they make engines. And they make engines in particular for large aircraft. They're only one of their three manufacturers globally, Pratt & Whitney, GE, and Rolls-Royce. And what's really interesting about this stock, yes, they are based in Europe, as you mentioned, but Rolls is selling their product to airlines who are in turn selling their aircraft to Middle Eastern and Asian buyers, some of the biggest buyers of wide-body aircraft. And what's more important is this aftermarket situation with Rolls-Royce. They have a huge installed base, and that installed base gets larger and larger. So this is what we're looking for at Causeway. My colleagues and I want to find companies where there's a change to the better for shareholders. And in this case, this company has got a large number of engines sold between 2002 and 2005 that are now moving from the warranty period to a maintenance period. And that means operating profit margins for Rolls-Royce will go up demonstrably, we think from 10 to 14%. And that means more profits and a higher share price. So
every time you buy an A380, the big double-decked Airbus superliner, you're buying Rolls-Royce jet engines, and then you've got that aftermarket. All right, we're going to talk more about buying some companies that have a global presence. Sarah, I just want to reiterate for those that weren't necessarily looking at the details that all of these news events, they're important. You absorb them, you put them into your analysis, but that doesn't necessarily drive your action when it comes to picking individual stocks. You're looking for companies that have specific characteristics, right?
Absolutely, and our holding period is several years in duration, so a short-term earnings blip may only be an opportunity to learn more about the business and discern its vulnerabilities. There are so many great companies out there that have gone under the radar, and we've noticed this in both our global value portfolio and our international fund. An example would be Babcock and Wilcox. Here's a company that was spun off from McDermott a year ago, and they dominate the coal-fired boilers. They're instrumental utilities. Whenever we have more carbon legislation, or any, and we force our utilities to clean up even further, they'll be the ones who coal. They have almost 40% of the nations of the U.S. Boiler market. Not to mention they have nuclear submarines.
I was going to say they have a big lock on providing the turbines that are used
the generators.
in the generators that are used in the nuclear powered submarines.
You get all of this plus the potential for a modular nuclear reactor that could be sold to many markets around the world, and all that in a company that has no debt. It is a $3 billion market cap company gone completely under the notice of investors, and that's the sort of business we want to own in a value portfolio.
Why has that gone unnoticed by investors, do you think? I mean, it's not necessarily, a social media enterprise. It's not creating, businesses that sort of thrive on, generational economics and demographics. Why have investors shifted their attention to those other things?
Yeah, well, there are crises that have cropped up around the world. Our institutional clients are certainly concerned about them. You see in Europe a debt crisis that is only rivaled by what the world went through in 2008. Japan has had an absolutely enormous quake and subsequent tsunami. There are not just natural disasters, but human-inflicted disasters. And so there are stocks such as Babcock that just simply haven't reached the computer screens of analysts. And that's what we want to identify. And even in crisis-torn parts of the world, there are great stocks to own that are in some way, shape, or form disconnected from a lot of that crisis.
All right, well, let's use another one as an example, right? Because you've got Reed Elsevier is a publisher, educational material, trade journals, and, of course, based in Europe and perhaps getting hit because many money managers are taking a look at their European portfolios and saying, it doesn't matter, just get me out. I've got to reduce my exposure to Europe.
Yeah, well, I think there's this company may very well be a casualty of some of that exit from Europe. But their issue is very company specific, and it's all about them taking what they have, which is a great cash flow generator in those journals you mentioned, and in their exhibition business, and in their databases, and exerting more pricing power as global mergers and acquisitions pick up pace, which will happen as credit becomes even more fluid. We expect the demand for the databases that this company controls to rise as well. In the meantime, investors are getting a healthy 5% dividend yield and another company with an absolutely fortress-like balance sheet. So the risk of owning Reed Elsevier is low and the upside potential is quite tremendous.
All right, so Reed Elsevier, Babcock and Wilcox, and Rolls-Royce. Is it challenging when you talk to potential investors to get them excited about these individual companies? How do they express their anxiety? Because it doesn't seem as though at least the retail investor has joined up and decided, oh, we got to buy stocks. Stocks are the place to be. You've seen so much retail money go into bonds.
Our research team has shifted its focus into an area just to quell investor nervousness, meaning we're looking not only, as we have always done, for financial strength companies with fantastic balance sheets, but we're also now deliberately looking for companies that control or dominate their industry, who are in an oligopoly or a duopoly, even better, companies with pricing power. Those are the two most important words out there in the research world right now. And once we've found that, we can build a portfolio of those companies. We can dampen the volatility that so unnerves investors.
Talk about that volatility for a moment, because, as you say, it unnerves investors. And I admit that we speak to people who say, well, you can profit from volatility. Does that make any sense, that you can profit from it? I mean,
well, that's somewhat of a loose way of putting it, but in effect, our investment team does something just like that. We add risk to the portfolio when our fund shareholders will get paid for it. So when it's appropriate, and I'll give you an example, late 2008, early 2009, when the upside potential on equities was enormous, we added risk to the portfolio. We deliberately took on volatility because we knew that our institutional clients and our fund shareholders would get paid for it. And now we're in an environment we've been taking some volatility off because the returns aren't nearly as spectacular as they were at that point in time.
So looking for those companies that have those solid balance sheets, the pricing power, and that duopoly or oligopoly characteristic. And low valuation, of course, value investor. I want to thank you very much, Sarah Ketterer, coming to us from Causeway Capital Management, sharing your thoughts with us. $14 billion under management. Thank you very much.